Important information and disclosure. TDW Trader Live seminar presentation is for educational purposes only. All trading ideas discussed by the instructor are for demonstration purposes only. Trading involves a substantial risk of loss and is not suitable for every investor. Past performance is not necessarily indicative of future results. Please read more at https://ttwtrader.com/disclaimer. Let me add another idea or thought to the limit order book. We haven't discussed it yesterday, but it's quite important to know. The limit order book, as we seen it yesterday, has limitations. When you look at the limit order book, it's absolutely amazing what information you can get out of the limit order book. But let me say that it is true for treasuries, for an S&P, for soybeans, for German Bund, for example, and other markets which are providing good liquidity. By that I mean the limit order book has its limitations in extremely thin markets. Let's have a look at oil, for example. Let me see what I have it here. No, I haven't recorded it. As well in stock markets, a limit order book is also absolutely helpful if you are trading stocks, Apple, Microsoft, and other shares. But when you look at the oil, for example, it's getting a little bit more difficult to understand and to read the limit order book. I have some recordings, or we will see some recordings, and the limitation of the limit order book is the thinner the market, it's getting harder to read the limit order book. And I would even say, if you are maybe trading the future DAX, German DAX, it's impossible to follow the limit order book. It's impossible because on every price level you will get only 5, maximum 10 contracts. Let me show you what I mean here. Come on. Look here, this is the oil future, and I have described something what to trade. So from my experience, you see on every price level we have 40, 50, 80, 100. It's a lot of 120, 150 maybe. It's the highest number in oil, maybe 200 contracts at a price level. So if you look at the FDAX, then you see this picture here. And we are talking about 4, 2, 3, 5, maybe 10, 15 contracts on a price level at FDAX. It's simply impossible in this case to watch the limit order book. It even doesn't make sense. So the professionals and the institutions are trading the DAX via options, for example, but it's impossible to trade it on the order book. It's so fast that you can't follow them. And look at the 6E, the euro US dollar. You have a similar picture here. So the market is relatively thin. You see we are trading 40, 50, maybe 70, 80 contracts pro price level on price level here. That means it is possible, but it's absolutely hard to follow on some not some days, but every day session, the limit order book alone. So if you want to trade the euro US dollar with a jigsaw trader, for example, it is really hard to follow. So there's one guy who sells 100 and more contracts. It goes so fast down or so fast up, it's impossible to see that. But watch at the 10-year note, for example. We are dealing here with 4,000 thousands of contracts per price level here. So if you look at what's this? This is the 30-year bond. Look here. We are dealing with 500, 600, 700 contracts per price level. If we are looking at the S, like today, we are trading in normal times, we are trading 400 and 500 contracts per price level. This gives us the time, this gives us, the German Bund, of course, as well. This gives us the time to really see what is happening here. Because you remember yesterday, the matching algorithm has a certain logic. First in, first out. Like in our game, we have time. It needs time. So when Angelic bought 4 and then the Bart came in and bought 10 and George bought another 8, I have to manage it manually yesterday, of course. But it doesn't matter. It takes time to update the limit part here. It takes simply time to update it. So I have to manage all those participants here, and I must update this price ladder or the limit part of the price of the dome here, and it takes time. Please keep in mind that the limit order book is an excellent tool, and it satisfies our left part of the brain because it contains all the logic here, how market works, but it is harder to read the limit order book in absolute thin markets. If you want to trade with the limit order book, look for good liquid markets. It is much harder. Yes, let's say my experience in oil is not the best. So I don't like oil because it's sometimes so crazy. I can't, from my point of view, I can't manage that. So it is getting much harder to trade oil with a limit order book than for example, here, the 10-year note. You see what is happening. You have all the time to understand what's really happening here. Is bigger liquidity going to be better for us and analyzing the markets with Bookmap? Yes, it is better because let me illustrate it with the left and right brain. We have, let me show that here. We have this numerical part. So this is the limit order book. We see exactly what is happening. Although we have an relatively thin ES these days. So we are not trading 400 and 500 contracts per price level. But it satisfied our logical thinking if we are accustomed to. And secondly, we see in the visualization part here, and we will go through it in depth, how these numbers are depicted here in this part. In this part of this presentation platform. Bigger liquidity is better, but if you want to, now I don't have an example right now here, but if you want to trade CL, for example, or NQ, then it's good to know what is happening here, but it will be It will be, and it is much harder to follow the numbers here. It jumps, you can imagine, if something happens here, it jumps 10 price levels up and then immediately 10 price levels down. I would like to add another point we haven't discussed yesterday, but it is extremely important for you maybe to, not to discuss with me or with us, it is your personal decision, but you should think about what is the best instrument for myself. Every one of us is a wonderful individual. Every one of us has his strengths and weaknesses. And in some cases we are told, come on, you trade Forex, trade Forex. Forex is the only market you can trade, for example. Or trade FDAX. You have to trade FDAX. Who is saying that FDAX or Forex is the right instrument if I want to trade? Who is saying that? Maybe Bart doesn't care about time, so he can sit around for 2-3 hours and watch this. Let me show that again, and watch the 10-year note going slowly up and going slowly down. And maybe Bart is the one guy of us who is very fine if he can get 4 ticks out of the 10-year note here. Who is saying that Bart has to trade Forex pairs? Who is saying that he must trade FDAX? No one. It is a person. It must be. Yeah, let me. I don't like the word must, but it must be your personal decision what you want to trade, because you know yourself the best. So if you are a speed junkie, for example, you have to go with NQ or CL, for example. If you have time to watch and to decide, then use, for example, yes, or soybeans. Have you ever traded soybeans? If not, big mistake, do it. Very great market to trade. So if you have more time, and it doesn't matter, speed is not a point for you, so you have time and you feel comfortable to watch the orders here be matched on either side, and it takes maybe half an hour to press the price up or to lift the offer here, then trade the treasuries. Treasuries, by the way, are the best instruments you can trade, because you get every time a fill, you have no slippage, and the future contracts, the commissions and turnarounds are cheaper than trading yes, YM, and Q or similar. This is what wrote in the chat. Bigger liquidity going to be better for us in analyzing the markets with Bookmap. You will see other techniques who allows you also to trade oil and NQ. We will come to these techniques. But you will for sure miss this part here. Not miss. You should have it on your chart, of course. But it doesn't give you the time. It doesn't give you the time. To reconsider. Oh, like you remember yesterday, we had 1,000 contracts and the price didn't drop further down. It's nearly impossible to see that. If you're trading oil, you have to look for 100 and 150 and 200 contracts, and at that level, what happens at that level? Question: FDAX is a very thin market and is moving like crazy, but is it possible to trade it with Bookmap? Theoretically, yes. But we will have the following discussion on liquidity. Main point is, when is liquidity reliable? And by the way, liquidity is, you see liquidity here. We will go through this example after the liquidity section. You see liquidity here. But when I can't do that here. But when I zoom in or when I zoom out, all this becomes relative, because now the liquidity at 25.75 pops up here. But if you yes, zoom out, then this liquidity disappears because this liquidity is higher than this one. I would not recommend trading FDAX. If you are an option trader, then of course you should use options to trade FDAX. You can trade a German Bund, as shown here. Let me see where it is. Here, for example, it's the same behavior like, let me say, yes. Or try other products. You are not forced to trade ES. You are not forced to trade the Bund or the Treasuries. Use other products which are maybe interesting as well, or very interesting. So because if they are trading in one direction, then this direction goes on and on and on. So it is much easier to manage your trade then. This is what I wanted to say to limit order book and yesterday's discussion. We have seen the logic of the limit order book, the numerical part, the logical part, what is happening in the limit order book, and we will now go see the other pieces to complete the picture of trading. We start first with liquidity, because liquidity is the main concept of all liquid markets. Without any liquidity, there is no trading. Let me allow to say following and to record following, because I had these questions a lot this year or during the year. The main difference between my seminar, which is subject to a fee, and other free available webinars is the fact that I'm showing and will show the whole trading picture. You will learn about limit order book, its usage, its limitations, and as well the market mechanics, the visualization part of the limit book. It's, from my point of view, it's absolutely great having a lot of good webinars around, a lot of good and excellent webinars around Bookmap. Absolutely, no doubt, no discussion. But all those webinars shows or presents only a piece, even a small piece of the whole picture. In some cases, it leaves you more disturbed than before. Maybe you have had this experience during your journey and usage with Bookmap. My experience is that this happens more than not, because it doesn't help you as a trading individual to find your way through all this terminology and techniques, to connect everything together. Why? And I'm not sure who said it yesterday, because our main question is where and when to trade. Where should I trade? And when should I trade, guys? That's the main question. That's the holy grail question. We all know, and we are absolutely aware that there is no holy grail in trading. No way. No way. If you want to look for a holy grail, then look into yourself, but not in a technique, in a software, in whatever. The holy grail question is where and when to trade. This is absolutely paramount to understand. When you really understand how a market works, then you see when you see the correlations in the market, you can build your own strategy based on the whole picture. But it doesn't matter what colors you are using. As long as you understand what the market is doing, you can interpret the language of the market, and you will gain every day. You will gain confidence in yourself, then in your trading method and your knowledge about markets and how to act upon this knowledge. That's the point. When you see and that someone is talking about liquidity. Liquidity is only one part of the market. Only one part of the market. We will go through absorption. We will go through exhaustion. We will see other techniques or terminology, what the market is doing and how the market is reacting at certain price levels. And our solely question, or our question is where and when to trade. I would, my goal for this week is to get to the answer where and when to trade as close as possible. It's really hard to answer. You won't get a 100% answer on where and when to trade. But yesterday we saw in this example, in the replay, that the knowledge of limit order book and its behavior, its mechanic, is extremely helpful to understand where the market stops. And when you recognize where the market stops or where it wants to reverse, and why is that, and why happens that at this certain price level, then you can answer for this certain moment. When this happens, this is the place to trade, and now it is the time to trade. And let's try to avoid following mistake in trading, to think about the past and to think about the future. In trading, we must trade in now and how to say, in here and now. Here and now. When we are in a trade and it works in our favor, it goes our way, the market approves that we are right, then we can go into the future, and you will see how impressive Bookmap is when it comes to see the targets of the market or of the move you are possibly in. So, saying that, we are coming to liquidity. Please keep in mind, and we will see that it's only one. So where are we in our timetable here? We talked about the auction yesterday. We talked about the limit order book yesterday. We did a nice practice. And now we are talking about liquidity, absorption, exhaustion. Then we will see the sweep. It's an absolutely fascinating move of the market, and so on. But let's talk first about the liquidity. Modern market makers are not specifically designated market participants with special privileges. Instead, modern markets enable anyone to act as a market maker by offering liquidity to other market participants. So you and I, we are market makers because when we are sitting on the limit part of the order book and the limit, so offer or a limit bid, then we are providing liquidity to the aggressors. The consequences of this widespread usage of the limit order book in our electronic markets today is a kind of blurring of the lines between liquidity providers and liquidity takers. Today, in these electronic markets, we are all liquidity providers. We have to know that the liquidity is the blood of all markets, because without liquidity, we can't do anything. Market needs sufficient liquidity to attract active and passive buyers. Market support buyers on the offer by providing liquidity. Market seeks buyers or sellers for distribution in priced zones. You will see that. Maybe you have had a chance to see my YouTube video, the second part of the YouTube video. This was a distribution, a wonderful distribution zone. Wonderful distribution zone. And if you know that this is a kind of distribution, they're trying to lock in buyers and they are selling everything to the buyers. And then what are they doing? They reduce or canceling the bid size, the bid side, and then let the price drop down. So if you are a buyer at the top, you have to cover. And that means if you are covering, then that accelerates the move down. Market uses liquidity to pressure the price down. Market uses liquidity to pressure the price down or up. That's I must correct this one. So if you have the imbalance on this side, the market is probably going down, and otherwise if you have the imbalance or this side and a thin ask side, the high probability is that the market is going up. Yes, liquidity, and that's one of the sentences we must keep in mind. Liquidity attracts volume or attracts the price. Liquidity is easy to manipulate. Yes, that's what we discussed yesterday. It can be cancelled immediately without any announcement, without any notice or whatever. Liquidity quickly vanishes from the market. So liquidity is something we see in the book, but we have to distinguish between good liquidity and bad liquidity. Or coming to the question, when is liquidity reliable? When is liquidity reliable? That's the most important question for all traders. And that's a point I'm missing so often in a lot of webinars. You won't get, or you can't, or you won't get a clear answer on that. When is liquidity reliable? Let me stress this again. I highly recommend to read this book or to get the Audible. We humans beings are attracted to the system 1. Fast, intuitive, emotional. Fast, intuitive, emotional. By that I mean, if we see a red line here, then we want that the price goes towards this line and then drops back immediately. So by that means we have a signal line here, and once the price touches this line or this area, I have to sell because this is the signal. I have to sell. This is what Kahneman describes here. This is the system 1 in us and every human being. There's no. It's not about trading here, but it's also about investing. It has nothing to do with trading. But from my experience this year, people are looking for fast, intuitive, and emotional systems. So let me show where to trade. Yes, that's great. This is a red line, so I have to sell. And what happens then? Mostly, this is either cancelled or the price goes immediately through these red lines here. So I'm sitting there on my position, I'm stopped out, and then I'm looking back and so and mostly I think asking himself, what's this? What is this kind of software? It doesn't help me anyway, and blah 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 blah. You know, there are a lot of arguments you will find that it's not you, or it's not me, but it's the system here. It's this chart. It doesn't give me the right signal to sell. This is what is described as fast, intuitive, and emotional. System 2 is slower, more deliberative, and more logical. That means we are now starting to distinguish between, is this red line really, what makes this red line reliable to me? Is anything what makes this red line reliable to me? This is slow thinking. It takes time. It takes energy. It takes, yes, it needs experience. It needs experience. Simply that is that. And once you understand that this line is not reliable because it's 300, it's not enough to resist the price, for example, you will learn to distinguish between a reliable liquidity and a not reliable liquidity. I have written down some conclusions on that, and I kindly ask you to keep this always in mind when we are going through the examples. Market always seeks liquidity. Liquidity acts like a magnet, or is a magnet. We will see enough examples, please keep this in mind. Liquidity is reliable if it is firm and stays firm. That means long-term liquidity, where you see a good number of contracts sitting. It is reliable when you see stacking in the limit order book. Liquidity is weak if it is short-term liquidity, because then it acts as support or resistance. And I have a picture. I have a picture here on a slide here, which shows that the price is always seeking the path of least resistance. Liquidity is weak when it is short-term liquidity, because it's only supportive. Liquidity is using to push the volume, to push the traders towards a certain price level. And liquidity is weak if you see pulling in the limit order book. Liquidity needs to be taken by an equal amount of volume. That means absorption. We will talk about that because it's absolutely important. Liquidity acts like a catapult support. So book flipping, spoofing, long and short-term liquidity. This pressure from the upside or from the downside, from support side or from the resistance side, it's to bring the price into a certain price level. That's absolutely important to know. And to do that, market uses liquidity. Look what I did yesterday. How I manipulated the limit order book or the liquidity. I simply added, while we are, I think we have selling here, or you had sold something here into the bid, and what I did is simply increase the numbers here. I simply increase the numbers. I can do that by 35. I can do 67. I can do 32. I can do 54. Whatever. And I have manipulated the direction of the herd. Yes, of the herd. I have manipulated the way of the herd. That means I wanted the herd, this is the coral, maybe this 80, 90 area is the coral. I wanted to manipulate everyone to go here to buy this 90, 80 level here, or to sell into this 80, 90, because my intention was I wanted to buy 80, 90 and then hit the and then reduce. Once this is done, then I can do following and reduce this one here. This side, the offer side, and you see what is happening very easily. Now I'm in the position because I'm holding my contracts. I bought it with 18.19 and my intention is I would like to sell it at 140 or whatever price here. That's my intention. And in order to get this, achieve this, I need to bring the price in a certain price level. It is calling accumulation. It is calling accumulation. This is the term for accumulation. I want to accumulate my positions here and buy everything what I can get at 80-90. And then when I have done my business, so when my inventories are full, so I've bought everything I've got, then I'm closing the door here. This is the coral. I'm closing the coral door here, the gate, not the door but the gate. and then open the gate to the other side here. So it's much easier for the participants. They can't sell anything because there is no more, and they are trying to press the price up. So when liquidity disappears, lack of liquidity sit on hands, you will see a black hole, yes, black space around the price when there is no single liquidity around. So let's talk about the last two foils of this presentation about the liquidity and the conclusions. Do you have some questions about that? Or do you have questions?
Yes, Bart. I just want to ask, maybe not sure if that's the question for now or for later, but sometimes it happens that the liquidity levels are attracting the price, so the price goes towards the liquidity levels, and sometimes those liquidity levels act as a barrier, as a stopper for the price, and the price is bouncing. So maybe at some stage, if you could discuss that as well and explain in what situation is this happening?
Okay, yes, Bart. I will talk about it for sure, but I would like to postpone it a little bit. So let's talk a little bit later about this behavior of the markets, and please come back again. We have a nice example from yesterday, by the way. It was great. It was a great day. To talk about liquidity, and I'm happy that I have recorded it, and we will see that when we finish the liquidity part. Yes, we will talk about that, and please, Bart, please keep it in mind. Come back with a question when we are in the exercise example. The most important point, market always seeks liquidity. Liquidity acts like a magnet. Let's have a look at this. I'm often talk about energy in the market, and we will come back to the absorption part. Therefore, the question was, if we have fast markets like NQ, for example, and other markets, does this apply to does this technique apply to every market? Yes, because when liquidity absorbs volume, the participants who traded at this price level or this price level or that price level disappear from the market. And you will see it might not happen at the top or at the bottom. This happens mostly before the top and mostly before the bottom. Maybe this picture is not accurate enough because it suggests that there's energy. There's energy. But what I wanted to say is simply, if liquidity and volume collide, then those traders are out of the market. They are not in the market. The business is done for them. And we will see that the market anyway goes a little bit higher or a little bit lower, depends on where the market is. Okay? So whenever market volume and limit volume collide, volume or energy is taken out of the market, energy is absorbed. It's not quite the right terminology. Energy is, I would like to, yes, I'm working with the term energy, but it's the volume which is taken out of the market, and this volume doesn't support a further up move or a further down move because it's taken out of the market. So on the other hand is that less energy or less volume remains in the market. You can, by the way, you can use your own expression or your own picture for that. This is only my how to say, visualization of the market. This is only my view of the market. But the concept is clear. Call it what you want, call it like you want. When volume disappears out of market because volume hits liquidity, and liquidity sits there on the limit side of the book and consumes every part of the volume, then the idea behind is that there's less volume in the market at that moment, and it means in normal times, in normal trading, then there is less energy to move the price up or to bring the price down. Let's go back to our example. Excel. Look here. When we got given that this is traded, you see that we have liquidity here and 45 contracts hit the bid here. Okay, that means these people are done and the market is trading here at the 90. Now, given this is a very small market, it's a bazaar, and one bought every orange or apples or whatever here, and no one is interested to buy more in this case, because there is no party in this market who has the power to break this 34 down. Maybe there are still 12 who are trying to get that at that price. But if this dries out, then the price will stop and maybe buyers coming back and buying or lifting the offer here. That's the point with when volume disappears out of market. So this is another a little bit exaggerated picture here. As said, use your own fantasy. Use your own fantasy to get this picture into your head, to understand that this is liquidity, and when volume hits liquidity, it comes to an absorption, and all this power disappears out of market. I'm not saying that it is not coming back, but when we see this huge absorption at certain levels, it can happen one time, and it can happen 2, 3, 4 times before the market dries out. So, but keep in mind that one of the most important part in our consideration about the market and discussion here is liquidity, volume, and absorption. We will come back to this very, very soon. So let's see some examples here. Because you see that the limit order book allow traders to either provide firm trading opportunities to the rest of the market. As we said, this is liquidity provision here, or to accept such trading opportunities, liquidity taking, and that's what happens. So we have liquidity here most of the time. We have, or not most of the time, when we see long-term liquidity, we will talk about this terminology here, then we will see a lot of traders sitting here. Maybe this is an institution, this is one big trader who wants to be hit here. And watch here, what is happening here. You see these huge dots here. So let's only speak the visualization of the market for itself. You see there's large volume cluster, there's large volume traded at those levels, and then it comes back, but with low volume, extremely low volume. This business for this guy or this institution or whoever it is not done yet. because maybe either he is protecting this level or he wants to be hit. He wants to close his positions here. So mind the big bubbles or the big dots, because they are indication that something big is happening in the market. Okay. Liquidity. It's quite easy. I think everyone understands what is red or yellow lines. It depends on what are you choosing here is. But look here, and this is absolutely important. This is absolutely important. You know, it's easy to talk about liquidity. There's a red line and the price goes towards this line and liquidity attracts price and blah, 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 and so on. But have you ever thought about that liquidity can vanish, and that this is an absolutely important indicator for you, for us? You know why? Can you answer why is this an important indicator here?
Stand aside.
Yes. Why?
Because price could go against you very quickly since there's no liquidity.
Yes. You see, there's nothing. This is the space around our planet. There's nothing. Nothing who can or would support you or whatever happens. There's nothing. Keep your hands off. But when you see it on the candle chart, you can't see that simply on the candle chart. It's not possible. But when you see that, it can happen because you are not aware that someone is tweeting. You know, it's common these days that Mr. Trump is tweeting, and this can change the market in either direction here. When this happens, the market indicates they are so fast. They are so fast on both sides. Look here, there's nothing left. And this remaining eight guys here, let me say, there are guys, then the man who wanted to trade this, and this remaining, what is this, 5 or 7 people here, they even don't know what is happening here. They don't know what is happening here. You can't see that on any other chart. So if you see that, maybe it flashes up for a few seconds, close your positions, or if you're not in, wait until this settles. We will talk about that in the sweep section.
Walter,
yeah.
If you go back to that one,
yeah.
Can you have an inference on the chart of, if you notice where the liquidity goes away and you look that the price, the liquidity stays in the market up there on the top side at 52.50 roughly, and on the bottom side at 51.80, roughly 51.82. Can you infer that this is a value area and that those are buying and selling areas?
You mean this one here?
Time?
You are talking about this areas. If this is a buying, if this is
that would be a sell, and then down there that would be a buy.
Yeah, that's really hard to judge. So in this picture, I wouldn't like to say that, because it's only a snapshot. We will see in our examples how you can better judge whether this is a support area or a buying area or selling area. In this picture, I don't know. This is very relative. Look, this is extremely thin here in comparison, because everything on this chart depends on the zoom factor. So this is now, what is this? This is orange here, and this is light yellow here. You can't say that this is going to be a resistance area and this is a support area, for example. In this case, we will wait until liquidity comes back, and mostly when you have oil inventories, for example, or Fed announcement, or non-farm payrolls, and other important announcements, economy announcements, then you will see that this every liquidity vanish. disappears, is cancelled, because all the informed traders, and guys, we are now informed traders, disappears from the market. They know what is happening. They know there are news coming in. They know that the echo numbers are coming in, and therefore they are cancelling everything on the bid, on the ask side. However, there's nothing here. And that happens not only for oil, it's only an example, it happens for every single instrument. It happens for for treasuries, for every single instrument you are trading. So absolutely important to know that liquidity can be depicted, or can be not drawn, can be depicted like on this chart here, this way. Also, liquidity is subject to change. That means, look here what happens here. What happens here? If you look very closely to the colors, you see how they are. I think this was a question. I think it was a question yesterday. You see how they are cancelling and adding liquidity. Whether we can see the cancellation at one level. Yes, you can see cancellations on one level by watching this color here. It's so extremely helpful, because it is, I say maybe you are better than me, that it can, yes, it's possible, but you can't see that if you look at the numbers here. It's not possible to see that. So it's easier to watch this red band here. It's dark red, 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 darker red, light red, light red. Someone hits this 23 even, then it becomes dark red, and so on. So what I wanted to say with that is that the liquidity remains firm, because these guys here are supporting these levels, at this level 23. You see that in the numbers, in the limit order book, as well you will see that on the chart. Now, this is also quite interesting and impressive, because you see 1,500 sitting on 23 even. They have sold into the offer. So these buyers were satisfied. And now see what happens. What happens immediately. I'm going back up a little bit. We will see that in the sweep section again. We are trading here 1,577, roughly 1,500 contracts at 23, and suddenly something happened. Don't know why, I can't remember, but anyway, it doesn't matter what happened. Suddenly something happened here. They hit this 1,040 or 1,400 or 1,500 contracts immediately. And therefore, because there's no or very thin air above this 23 even, the prices jump up. It was so hard. I think this was a 10-point mover immediately. In 2, 3, 4, 5 seconds. It is jumping up. It takes all liquidity here. And it was such a massive move that every queue was depleted on the way up. Okay, I would like to postpone this discussion because we want to go to the exercise, which is more impressive than the discussion. Let's talk about the long-term liquidity, and let's talk about the short-term liquidity. Long-term high liquidity remains in the book, defines the auction, digested by the auction participants, channeling between longer-term liquidity, we will talk about the channeling, and acts always as a magnet. We will see this liquidity. We can build a strategy upon that. When we understand that liquidity acts like a magnet, and we are trading this area here, we know that we can't sell at the moment because there's nothing. There's roughly saying nothing here on this chart. But we can say we have liquidity here at the 95, we have liquidity at 800, and we have liquidity at 805 here. So if our theory works, then we can say liquidity acts like a magnet, attracts people, attracts the market. And maybe some of the market participants, the big guys, not we, not us, but the big guys, want to be hit here. Who knows what intentions they have, but they want to be hit here. Absolutely. So this is, going back, this is long-term liquidity. Channeling between long and term liquidity act as a magnet. Yes, we should understand the context of the area. Is more or less liquidity around the area, or are there tendencies to pull the liquidity? So again, to show you that, you can see in pulling the liquidity here with this, within this color band here on this price level. Adding, pulling, adding, and so on. The question was, can we see when liquidity is taken or pulled or cancelled? Yes, we can see that. This is long-term high liquidity. You see that long-term high liquidity, I would like to define it roughly. So what anything what is sitting in the book for more than 1 hour, is in my eyes long-term high liquidity. You will see that it stays in the book for at least, yeah, that's not the best example, at least 1 hour. It starts at 8 o'clock here, my time, and it lasts a long time. Long-term high liquidity. That means you can make your own rule, but and everything what is longer than 1 hour in the book, it's long-term liquidity or long-term high liquidity to me. So you see that here, it stays in the book. Maybe long before that. This is what is this? This is Apple. This is Apple, for example. Look how they are protecting this area here. If you're trading stocks, you can also use this technique to understand what the market is doing here. Using the limit order book, you see the numbers. They are stacked. Added 18,000. I think 80,700 shares on the 155 even level here. They were hit here, but it wasn't enough power energy to break this this floor, the support here. You find these examples in shares in Microsoft, Apple, Amazon, and so on and so on. Only a few points here to show you the ideas, what is really happening. At this specific day, they even didn't touch this liquidity at 70, 69, 75, 70 area here. And while this happened here, the liquidity starts to build up here. The liquidity starts to grow. Absolutely important, interesting to see. And then, and that's what when I have time to tweet something, then I'm writing business is done. You'll see how impressive this is. This is intention. That's not coincidence. This is intentional. Why? Because they have cancelled everything. And the bad point is they are cancelling that 5 minutes later, after this event here. But anyway, it shows if I am long, then this is the indication that I'm right. Let's talk about the short-term high liquidity. Short-term high liquidity briefly is briefly in the book. creates large auction imbalances. That means short-term high liquidity is a supportive indicator. You will see it in the book by auction imbalances, book imbalances. Someone is trying to press or to push the price in a certain direction. That means new info arrives at the market. They want to skew the auction and they want to bring the price to a certain price level. Let's have a look at the short-term high liquidity. You see how short it is. Here and here and here. Short-term high liquidity. Short-term high liquidity from bird's eye view here. If you zoom out, we have long-term high liquidity. This is the euro US dollar. Long-term high liquidity sitting here. A wonderful indication what the market is probably going to do. And they are adding liquidity. They are adding bid support, bid support, bid support, bid support, bid support, bid support, until they are going to hit this level here. This is short-term. Yeah.
Walter, what's your definition of high liquidity, and is it different for short-term versus long-term?
Short-term, it's only in the book for seconds to minutes, but it's high. It's high in comparison to the adjacent liquidity levels in the book.
Is there a percentage level or a number that you look at? I know it depends on the market.
Yes, it's the number. So that means if you are talking about high, let me see whether we have a better example here. We have for a very short term, I don't know whether this is maybe a few seconds or maybe a minute here. Maybe these are 1 or 2 minutes. These are even also 1 or 2 minutes. By that I mean this is a very short term liquidity. So the market is using this kind of action to press the market up or down. So
but on the volume side,
yes,
let's say, I understand the time side. I'm talking the volume of the high.
yes.
What's the definition of the high liquidity and volume? Is it 100% of adjacent volume? I mean, how do you determine that?
To answer your question, in terms of volume, I wouldn't consider that is in percent as a percentage of that of this one, because it changes. If you zoom out, this will change too. So it's very hard to say this is a percentage of this level here.
Okay.
Yes, long-term high liquidity, and this is short-term high term liquidity. That's that. And what we must keep in mind, I've noticed that last week it was impressive that the liquidity or the price is looking for the path of least resistance. This is very clearly visible in Bookmap. Bid or ask side support the price move in one direction. It is the real-time evidence which way the market will go. It's a real-time evidence. It's not a game, it's not guessing, it's real-time there. Valid until resistance or support shows up, and that was, I think it was last week. It was last week, yes. Can't remember when, but you see that liquidity acts like a magnet. Liquidity acts like a magnet. It was absorbed here at that level. And what I want to point at, I'm trading. I'm hoping to get an excellent enter, that I will know where to enter and when to enter, and that I'm hoping for a 5, 6, 7, 8, 9, 10 point move. I'm not scalping. I'm protecting my stop, of course, but I'm trying not to scalp. When I see that there's more resistance, logically, because you can see that. You see these yellow areas here. And there's less resistance until 93 here. It's absolutely impressive to see that what is happening here in the book. So you know, it's really, really hard at that moment to sell. Even if you are an indicator showing something, might be divergences or whatever, is showing you have to sell it, but you can't sell at the moment. You can't sell because the resistance is here and not here. Maybe this is changing on the way up, so that this is becoming more resistant and this becoming less resistance. That can happen. But at that specific moment, when you are in the trade, maybe hopefully long, because this is our targets, this is our targets, this is our targets here. We don't know whether the price is touching this one, but we see impressively that there is less resistance than below.
Walter, on this one, would you say that there's more liquidity lower than there is going up?
Yes, because
then why would it be more resistant going into liquidity? Because price, from our slides prior, show that price attracts to liquidity.
Yeah.
So shouldn't the resistance be flipped the other way, because price would go towards the liquidity?
Good point. I know what you mean, and I'm looking to find an answer.
In essence, the struggle I have looking at these levels is, it makes sense to me that if you pull liquidity, price should go in that direction. And it makes sense to me that it's less resistance and more resistance here, because it's going to take more energy to get through the liquidity.
Yes.
However, at the same token, price is also attracted to liquidity.
Yes.
So how do you play that balance?
I'm trying to find a logical answer to that, because liquidity, in this case, we have different kinds of liquidity. Let's try it this way. We have different kind of liquidity. Kind of liquidity. We have high liquidity there, 1200 or 1300 here. We had high liquidity here. We had high liquidity there, here at this level, and we have high liquidity here. Liquidity attracts the price, but on the other side, and that's the balance we have to find. On the other side, let me complete this sentence. That's the balance we have to find, is liquidity pushes the price in a certain direction. We will talk about later, maybe today or latest tomorrow, tomorrow, about the active and passive indicators in the market. As I have showed here in this small case, I'm using the liquidity to make way for higher prices here. You see that I have reduced everything on the book. Then what I'm doing on the bid side, I'm adding liquidity to the bid side in order to make this way less attractive for the seller to hit me, or to hit this way to go down. My intention is, because I have bought 1890, my intention is to get higher prices. So if I'm in the position to play with those orders here around, then I can cancel everything on that, on the offer side, add to the bid side, and that indicates I have less resistance here than here. Let's given this is done here, then I'm trading this one. Let's given that I want to push it anyway a little bit higher. So what I'm doing is I'm placing 23 at 100 and adding immediately, let me say, whatever, 45 on this level. So I'm playing to push the price further up, because let me make this example. I have 54 at 160. So my intention is I would like to have the price in this high long-term high liquidity. Let's assume this is the long-term high liquidity.
Okay.
To high liquidity. Okay, long-term high liquidity. Then I have close design, and now I'm using a game who is saying spoofing, for example, which I'm trying to indicate, guys, no, not with me, guys, you can't sell something, but I'm very strong here, and so I'm playing 56, 23, 45, 56, and so on, and I'm trying to push the price further up with liquidity. And that's exactly what you see here. You see that you see the time frame. We have long-lasting liquidity at 93, and we have an what is this, medium-lasting liquidity here around 85, as well, and at 83, and also here. And what they are trying now, in comparison, consider please the time. Time is extremely important. See here, this is, what is this, maybe 5 minutes. Let's say this is 5 minutes. Then the next liquidity comes up here. No one is interested to go against the crowd here. That means we have high term liquidity here, and they are supporting with liquidity to drive the market up into this direction. To answer your question best, that's the balance we have to understand in our trading. So it is not, I wouldn't say if I'm going towards this liquidity that I must go against this liquidity again. You will see that in spoofing. Spoofing is a technique, maybe you have seen it already on your charts, that they are trying, it looks like a stair effect. The stair here, then the next brick is coming up here, then the next brick and the next brick and so on. It looks like a stair. You can even see a stair effect here.
Yeah. So
that's the intention of the market, to bring the price further up, to support it. It doesn't mean that mean that they won't hit this area 83 again. But when you are long, when you get an entry here somewhere, and you are long, when you see you have this picture in front of you, then you know I'm right. The market proves me right that I'm in the long position, and I'm riding thing as long as I got an absorption at certain level, or maybe even if it hits this 93 level. I would say, as a rule of thumb, look where it's more red, where it's dark red. This is your orientation. Anything what is dark red is your orientation, or our orientation. Anything what is white or light yellow, it is only supportive, and we should not try to sell it against and hoping that the price is going this yellow line here, or this yellow area here. So maybe let me think about it. Maybe I have furthermore think about your question, because my answer would be, at the moment, look at dark red areas if you have this chosen the dark red.
Yeah. So I guess then the thing that I totally, it makes sense to me that price would want to go towards liquidity. It totally makes sense to me for large magnet areas, and it totally makes sense to me that there's less resistance going to one of those areas if there is no liquidity in between. So I guess I'm trying to arrange in my head, and maybe it'll make sense after we're done with everything, is in context, what is the hierarchy? And I think you're alluding to that area up at 93 is definitely a magnet, and based on the context of the stair stepping and spoofing or pushing price up, and actually going through some of these resistance levels, like say at 83, and now they're pulling at 85. that it gives us clues to the general area of where we're going versus, and like anything, it's, you know, it's not foolproof, it's not specific, but the context of what, the way you explain that gives me an idea of the hierarchy of what is important
Good
to
point.
look at and what's not.
Good point. I think it's a good point to think in hierarchies. So that means we have more volume at those dark red areas than in those yellow areas. And then if we are going to prioritize or give them priority, then I would like to say first priority are these dark levels, dark red levels in this case. The second priorities are the orange levels, and the third priorities are the white and the yellow levels. This depends really on if you have chosen this color scheme here, yellow red. So it doesn't matter, but you have the dark yellow, whatever you are using. Answer your question also for other colleagues who are listening or who will listen maybe to this seminar, that we can sort the liquidity in different hierarchies. That means we can give them some priorities. The highest priority has this one, the dark, with the highest volume. Then we have the second one, the orange one, which is mid-term volume, and the lowest is the yellow white. So we can make a structure of them, and that means when I'm looking at this picture, then I have my targets here, here, and here. As long nothing happens along on the way up, it can happen that this flips around here, 88 for example, but we don't know that at the moment. I see white areas or light yellow areas here. That means this is a supportive liquidity which supports the move up. We have another point we have to discuss and must discuss. This is the time. You will see that we will talk about sweeps. You will see that the move is, how to say, creeping up very slowly. It takes this time, let me say this is 1 hour, 1.5 hour roughly, for the price to go up there. Then what is happening? Second, we have a certain angle here. That means this is a really flat angle here. I don't know what it is, but maybe 30 degrees, and it goes up, and it takes 1.5 hour to get there to this price. And you see the intention of the market. There is no, how to say, no aggression. There is no aggression in the market. So we have not only the distance to this 93 level, but we have also the time. There's no aggression, there's no enthusiasm in the market to bring the price up to 93 in this at that moment. It looks really weak. It goes to the first level. What is okay, which is okay, because if you are long here, if you took the opportunity to take this 81 area up to 85, it's 4 points. 4 points is wonderful. Every day 4 points, you are done. Absolutely fantastic. That's what I wanted to point, is that we have here important levels. I think, yeah, that's this is the view, a little bit a closer view on the market. And what I'm stressing, what I'm telling is, we need bid support to push the market up. We need bid support to push the market up. It depends really on sometimes, and I have witnessed that a lot of times in years, the market is going up, but there was no bid support. everything below this price was blue or cyan or whatever this color is. That means the market is not supporting. So there are buyers who wants to buy and they were feeded by the sellers, but there was no bid support. And we will see that by when we come to book flipping is we have targets, we have a hierarchy here at those levels, we have priority at those levels, and we have supportive liquidity at those levels, which means they are supporting the bids, they are supporting the bids, they are supporting the bids, they are supporting the bids. It's like here, you can do it by your own. They are supporting the bids on this side by the numbers and weaken the offer side until they got the fill at 160. Good. What you see is the recordings from yesterday. 8 o'clock. It's 8 o'clock New York time here. In this case now, let's only concentrate on the liquidity, okay? I will show you something interesting a little bit later together with the limit order book. But anyway, let's just talk about the liquidity. And let's start at 8 o'clock New York time, at 8 o'clock EST, 2 p.m. European time. And what I would like to do is to accelerate a little bit. So this was the pre-session. And let's do it a little bit faster here. Okay. Now, what do we see here? In terms, we are talking about liquidity, not about the price, not about the order book, not about the volume, and so on. We are talking about liquidity.
So we definitely have more liquidity at the top.
Yes.
At the bottom.
Yes. Good. But what do we see here?
Oh, not too much around the price.
Absolutely. A black hole. Let's see what's happening here. You see, without talking about the sweeps now, and please be patient, we will come to that this week for sure. So what we see first is when there's no liquidity around, and think about our last discussion before the break, that we have no resistance here. There's no resistance. That means there's no liquidity who is able or who is willing to catch this move down or to give support. That's an absolutely important part. When you see that, either you are lucky and you are in this move, then tighten your stops. But when it happens, it's so fast. There's no reaction time. It was a sweep. It was a sweep into the 20 area, and you see, yeah, that was too fast. Let me show you again. Look here at this liquidity here. They give way immediately. You see that? It happens before. Okay, anyway. It's too fast. You see that? The black hole, the black area around, nothing is around. We will learn how to trade these moves. How to move with this, how to cope with these moves here. Now liquidity comes up at 15. what is the difference between the price trading area here and the price trading area and the area here? What is the difference? Let me mark this one between this one and that one.
But there is a resistance at the second level.
You mean here? You're talking about. Sorry, you're talking about.
Possibly attracting a price.
Tom, yes, okay. Yeah, first of all, but what I would like to point at is look around the price movement. What do we have here? We see nothing. It's a black area here. You see that? There's no liquidity.
They're illiquid reversals.
Absolutely. There's nothing here. Look here. There's nothing. Everything can happen here. Everything can happen. But after a few minutes, liquidity is coming back. That means this sweep, this very hard move down, is finding a support here. So let's see what is happening. What happens next?
They stuck some sellers down there.
Yeah, look here, 31.10. Liquidity is coming up here. It starts to add. They started to add at yes, 2:30 my time here. 1 hour before they open. That means 9:30 New York time, EST. So they are trying. They are stacking here. They are adding to these levels, and this move, which was in a free fall down here, the prices find a support here. You see, the point here is not how to trade or what to trade. That's not the question now. But I would like to point your focus, I want you to focus you on liquidity, simply only on liquidity, because in an area where the price is coming down, no one who is informed wants to trade this area. No one who is really sound and healthy wants to trade this price here. But after a while, few minutes, they're coming back. You see liquidity here, and you see liquidity rising here. So when we are back to the idea, excuse me, just a moment, please. Priority 1, priority 2, maybe also priority 2, but let's see what is happening in terms of liquidity here. Again, important, when we have announcements or tweets or you name it, liquidity disappears. It's extremely fast. What is happening here?
They're following liquidity up behind the bids.
Yes, it is. Look here. Just to it's similar like this one here. So they are trying to support. You see this small parts of the liquidity here. This small part of the liquidity here. I bet this is also going to be cancelled. I didn't go through these recordings. I haven't had the time to go through this one, so I don't know what happens. But you see these bricks here, these stairs. They're trying to support the move up. Let me jump into the session open, because we will see an absolutely interesting trading day. A little bit back. So please comment on those both areas here, 10 and 14. Why is this yellow? Why is this red? Why is this yellow? Why is this red? Why is this yellow? Why is this red?
Because the volume is being added to this level, yes? This pen is changing the color.
It's been what? Sorry?
Excuse me. The volume is being added to this level. There is the color indicates more volume.
Yes, okay, yeah, okay. You can also say the volume was cancelled, the volume was added. Okay, yeah, you are right, absolutely. You see that. First of all, the volume is, now have a look what happens next, is added. We have 350 at 14. And now it's gone. You see how they are playing with these levels, 14 even. Maybe they don't know. They don't know. They know more. Excuse me. They don't know more about this level. Maybe there's something going to happen. Look here how they are playing. This is the same one as when I would play here with these numbers here. Cancelling, adding, cancelling, adding, and so on. It's absolutely the same. You see that here. Now let's jump into the open. And I would like to how can we call that here?
That's number one in the hierarchy of
Yes. And the full expression for the number one is, what's the terminology? How do we call it?
long-term liquidity.
Yes, long-term high liquidity. Long-term high liquidity. Yes, that's so. And now let's see whether our theory works or not. What is liquidity? How acts liquidity?
It's a magnet.
Yes.
And attracts the price. Well, I said it just basically acts as a magnet and attracts.
Yes, absolutely.
the price.
So we don't know nothing about the market and what is going to happen in right now in whatever 2 minutes. But we know following. This is a magnet area. This is an area of attraction because this attracts the traders to go towards 31.10. But because we are very short to the open, 2 minutes before the open, it's highly recommended to stay away and see what is happening at the open. Okay, which situation is actually evolving? What is happening here on the chart? This is the first seconds. We are 20 seconds after the open. And please comment on this area as well, and please comment on this area here. What do you think? What is this?
It's a huge volume level sitting surrounded by basically a lighter volume. That means this is, to me, this will be very significant level. Watch for, yes?
This
It's like
you are talking about this level here?
yes.
Good.
The red line, there is an orange line, and there you have two yellow lines, just like.
And can you tell how many contracts are sitting on this 31.20 area?
It's 1482.
Yes. And you see this what is this vertical line here, this this indicator here, this is the large lot tracker. That means you can adjust it in your bookmap settings. We will come to that on Friday. And it measures, or it's an estimate, that a huge part of this 1482 contracts maybe belong to one, I don't know, guy, institution, something like that. So this is really a serious...
Really serious about trading at this level.
Yes, absolutely. But we are, you see, first of all, the first impression, or the first view, when we are coming to analyzing the market, and we will see that on Thursday, how to analyze the market and what to see in the market. But it was extremely, this is an extreme situation, because look here, they added exactly at the session start at 9:30 EST in New York, exactly on the second, they added 1,482 contracts at 2050 in this area. You see that? How important it is to watch liquidity? There was nothing before. So they stepped in the office, and exactly at the open, they placed 1,500 contracts at 2050. But what we do here, we have here what? Below?
Below is definitely a lot less liquidity.
Yes, it is. It is. This is orange. This is orange. This is orange because this is dark red. This amount, it's 300, 400, is relative to this 1400 here or 1500 here. That means when we are going back a little bit, you see that it's dark red now, and we are looking to the open. Now it becomes more brighter. It's not dark red, but it is orange in this case. So you see that this number is that there's still liquidity. And to use George measurement system, this is priority 1, and this is maybe, yeah, that's now hard to say. Maybe this is priority 1B or maybe priority 2. However you want to define your scale on that. But we have still, yes, we have still liquidity there. Okay.
So what is the significance then, as soon as that liquidity came in, the liquidity between say 31.15 and 31.17, 31.17 and a half dried up? Does that give us a clue?
Yes, of course, absolutely. If you are not, yes, absolutely, there's nothing. So we have two poles. That means we have a north pole here, and we have a south pole here. If to say it in a little bit in picture. So we are trading at the moment between 20, or the market is trading between 20 and 10, and all those positions are trying to attract the price. But at the moment, at a very early open, it's really hard to say what is happening, because they are clearing their inventories. It can happen. Everything can happen. So either the best choice is, from my point of view, to wait until the dust settles here, and we have a clear picture what's going on. Let's see how this evolves. You see liquidity is coming in. We still really don't know. At least I don't know. I would like to wait what happens. So you see liquidity, long-term liquidity, priority 1 liquidity, priority 2 liquidity, priority 2 liquidity. We are not.
Spoofing from above to fill those 13 quarters, 13 halves, and then they pulled, and then price went up.
Yeah. See how they are using the mechanism of liquidity to manipulate the market. At the moment, in terms of trading, I don't have any reason to take a position here. I mean, it's fast. It's eightfold here. You see that? Just to save a little bit time. Look here. Business done. Trying to protect this area again. Let's do a little bit slower. Now they are approaching our first, which was first priority before the open area. This was the 3110 area here. And now it becomes interesting to have a closer look into the order book here in this area. Let's do it, play it forward here, because our first impression, and that what we see when the market opens, someone is placing a huge amount of contracts at 120, 20 and a half here. And that means something, guys. That means something. That's not for fun here. There's no fun in this business. But we here have a long-term liquidity sits 1 hour, more than 1 hour at 10. Let's see what is going to happen here. I would like to point your view again on the limit order book. When you want to trade with a limit order book, when you do it this way, then you see that the green bars, yes, are bigger than the red bars here. That means buying pressure. Buying pressure comes up here. They have still a resistance at 30 even. Okay, the question here is to buy or not to buy.
Hey, Art, I wouldn't buy here. I would rather sell, if anything.
Okay, good.
I wouldn't buy here.
You would not buy here, George, okay. Would you buy or would you not, to buy or not to buy?
Yeah, I think that was Bart and Tom that both said they would not buy. I agree with them. I think that 13 quarters have to break before I would buy anything.
Okay. Remember what we discussed yesterday here? Have a look at these numbers here.
I understand the buying that went on down there, the 487, the 420. I guess, does that trump that resistance at 13 quarter? Because it looks like there was some absorption at 13 even.
Yes.
And then they came in and are trying to spoof price back down again or
yeah.
defend.
But how do you? Why are you saying they're trying to spoof the price down? What is the reason that you are that you say that? How do you conclude out of this picture of this market that the price is coming down back or going back again? What is the reason?
Because of the liquidity that came in at 13 quarter after they were filled there at 13 even.
Do you mean this liquidity here, 13?
Yes.
But it's okay, good. We have a certain liquidity here. But we have what we have here is following. The market traded up, consumed everything on the ask side here. You see that? Green dots, green dots, green dots here. That means 30 even was absorbed. And watch here what is happening. It is the same behavior. I know it is, maybe it is, colleagues, it might be scary because we are not used to utilize or to use this information. But have a look at what is happening. They are trying to sell 950 contracts into 12 and 3/4, 12 and 75 here. Look at the pulling and stacking, the quotes delta. It's adding, they are selling, they are adding, they are selling, they are adding. Okay, now I'm with a normal speed here, normal trading speed. So do you see, just a moment, you see what happens here? They traded 1,000 contracts into 12.75 here, 12 and 3/4. Nothing happens. The price, yes, went down for 1-2 ticks, maybe 2 ticks. We will see that. Still, the traded volume is indicated as 1,075. This one. It's refreshing now. And that's what George said. This is a nice liquidity with 350 lots sitting at 13 and a half, 13 and quarter. The question was buy or not to buy.
So Walter, here we can see that this 1,000 contracts that they're trying to sell now is 383.
Yes, that was the refreshment. So they sold 1,000. That 1,000 was already consumed, and 1,000 is a huge number, and they tried to sell everything into the buys, but everything was consumed at that level. That means we have had a nice absorption here. We have, you see that by this volume bar here, we had a nice absorption at this level, and it happens. This is always the case. We will see that nearly every day, that this level was important for our trading. Now the question is, and should I go in here? If you are brave, you are taking the opportunity to get a fill somewhere around 50, 25, 75 here, somewhere around this, because you see what happened here. Now we have the logical information from the limit order book. We got a huge sell, and everything was absorbed by the buyers. It's absolutely normal that the price is trading a little bit beyond this level. They are trying to protect this level because they want to buy more. You see that? They want to buy more. And now look what happens. There are no sellers. No one want. We will come back to this, to the exhaustion a little bit later. This peaks here. You see that peaks here? This is the matching engine. The matching engine is asking, is someone willing to trade at 12 even with me? Is someone willing to trade at this price with me? Is someone willing to trade with this price with me? No one is willing to trade this and this prices at this moment. And because this was the absorption area here, around 75. The normal conclusion, or the normal, if we are used and trained and experienced on that, is to look to buy around this area here. to be long. Your risk is, let me theoretically talk about the risk is 12.25, maybe 2 points here, because your stop should be here at 9.75, somewhere here below this liquidity area. We will see that this behavior. We will see this behavior. We will see this behavior when we are talking about accumulation. Accumulation means that the price is coming down. We have a huge absorption, huge volume traded on a certain level, and then the price or the market takes time, maybe 1 hour, half an hour, 1 hour, whatever, to trade around this absorption area here. It's normal that it's going a little bit further down. In this case, it's accumulation. All this area is a buy area, but the buy area, the reason for the buy area is, we'll see that, is the absorption which happened before the accumulation starts to work, before everything was accumulated. We had absorption here on this level, and again we saw 1,000 contracts traded at 12.75, at 12 3/4. And now the whole logic fits together, because we said that liquidity is an attractor. Liquidity acts like a magnet. If this is true, if this is true, then the markets must go against this 31.20. And that's the beauty of this technique, and that's the beauty of understanding the market. Because first of all, you will see when we're coming to absorption that this is an absolute important point, because liquidity eats every volume here on this level. That was the reason for up prices or for rising prices is not here this level. That's only the accumulation area here. The reason is that there is no more sellers, or not, excuse me, there's not enough sellers to break the prices down, to eat everything on the way down. You see how the volume declines. Again, I wanted to point that out. By the way, I have uploaded the file, so you can download it from the Dropbox and go through this example again when you have time. Have a look at the order book. Be confident that when we are trading more than 1,000, for example, it's valid. I'm talking about ES Mini. So I'm talking about ES Mini. In other instruments, you will have other numbers, as said. In thicker markets, you will need maybe 5,000. In oil, you will see maybe 100 and 150, maybe 200 traded. So it's absolutely different. But we are talking now about the ES Mini. And in this case, when you see 1,000, 1,500 traded on one level, price level here, then be alerted, be cautious. And given that we have seen what happened, what is our next target then?
The 20 area, just below it.
The 20 area here?
Yep.
Yes.
Yes, I agree.
Okay, let's see what happened here. In terms of liquidity, what is this here?
Supporting.
Yes, that's sharp short-term high liquidity.
Oh, yes.
This is what is this, priority 2? Yes, it's priority 2. Liquidity. Again, supporting. Now it's bracketing. We will come to the brackets. It's catching the price between 15 and 13 here. What is happening now in terms of liquidity?
They're trying to push price down now.
Yes.
Short-term liquidity down.
Yes. And have you seen that? Just let me jump back a little bit. This is yellow now. It's getting more and more orange and red. Now they open the ceiling here.
Yeah, and I noticed that they also add a little bit more liquidity to that top line.
Yeah. But normally, and that's the ugliest part of the markets, given we are long here, because we recognized it was absorption here, we had a good indication, the order book here to go long, because they sold a lot into the bids and all the buyers absorbed the sellers. And now our hope is that's what I'm hoping, that they are going straight up to this level. So that means I'm in the trade from 45 to 15 minutes. They are touching this 20. I'm cashing in 7-8 points. Close to PC, enjoy my life. That's my dream. But you see what is happening? They are trying to fool the people all the time. And that's, by the way, a classical retest of the 12 and 13 area here, 11 area. So this is the classical retest. Not going into it. What we wanted to say is to learn is about the long-term and the short-term liquidity. So when this is all short-term liquidity, it is used to skew the price, to bring the price to a certain level, and to trade again. And that's the point. Liquidity in this case is firm. No one retreats, no one cancelled this liquidity here. It's still there. The question is, do we are strong enough to resist this, again, this retest against this 30-10, How do we act? Do we take 5 points out of the market here? It's really a kind of personal trading, and there are no rules for that. Okay, just to complete this view, something is happening here. I want to point out this one. You see the break. I would say this is, you see this line here, this break here, and that means something came up at yes, and shortly before 5 p.m. my time here. Something happened. You see the liquidity was cancelled all over the levels here. And you will see this, how to say, this breaks here, these lines. See that? This one here. This is a kind that at that point a lot of liquidity was cancelled on the bid side. For what reasons I don't know. But it's an indication that something might happen, or they're waiting for a tweet or an announcement. I don't know. Hard to trade, anyway, hard to trade, but what we should keep in mind is, you see that something happened here too, as well here too. But what we want to keep in mind, that liquidity is a map for us. So when we are traded on some days, we have a clear map in front of us. We know where a possible support is. We know where possible resistance is. We know where the price is possibly going to or heading to. It's like a map. It's not said that when we took this position here at 13 and it goes to 16, that it's going straight ahead or straight away here to the 20 level. It retests very often, goes a little bit more down, so we are scared about our position. It's going against us. We are nervous and so on. We are protecting, we are sweating about our position, but the overall direction was, yesterday at least, extremely clear. We have some days where it's extremely clear, everything is on the chart here, and we have a lot of days where it is not clear what is happening then. But it was evident that this long-term high liquidity here at 2050 or at 20 area here is the attractor for the price. Let's see how this worked out. I think they break this one. They broke this 20 area. We will talk today about absorption. In terms of liquidity, what happens and what are the next actions? First of all, the first question is, was the business done for these people here, sitting here?
Yeah, there's no energy left in the market now.
Absolutely, yeah. They wanted to be hit here for some reasons, whatever. I don't know. We can't say that, but it's not interesting for us. We only see we have a map, we have a compass, and that was this liquidity yesterday. Very clear, very clear. It depends on whether you can, yes, stay in the market or you will be stopped out or you take only few points. But if we recognize and have the patience to wait for maybe a retrace, we don't know to say very clearly at this point of the market, at this point of view here, when we are long, we are concentrated on our trade, to manage our trade. We can't know that the price is coming back. That's not possible. But anyway, this was our target, and if we don't succeed to get in the first run, in the first attempt, and if we don't have the chance in the first attempt to touch this one, then it is most likely that the market is trading down, maybe again this 3110, and then this acts like a magnet. Anyway, this is all theory, you know. This is all theory. In hindsight, we can explain everything, and that's okay for learning purposes. But when we are in trading, it's not okay, because we have to rely on that what we know and what the facts are. Again, the facts has been we had liquidity at 10 level and we had liquidity at 20 level. That has been the facts for yesterday's trading. And we have to find positions to trade accordingly and based on the facts the market is giving us, or gave us yesterday in this market, in yesterday's market. That's the point. It's extremely hard. It's really extremely hard. But once you know what this is about, you will see in front. And we got this information here. We got this information here at the open. We got the information at the open. What is the most likely development of this market now? Can we say something about that?
Probably higher.
Yeah. Why?
Because there's liquidity up at 17.5 that came in about the same time as on the open as the 20.5.
Yes. Let's see that.
Did you mean 27.5, George? The one that is above?
Yes. Yes.
But before, and that's the point here, you remember the, let me find, where is it? This one. You remember this one? More resistance, less resistance. It is more likely that this is an attractor here, 27. But remember, less and more resistance. Now we have more resistance here on the upside, and we have less resistance on the downside. That means I'm not sure, but I think George is right that this might be the next point of trading here, or something in between here. But at this specific moment, we have more downside than upside. And because of what?
So liquidity.
Yes.
Less resistance.
Yes, yes. Please keep in mind when we look at this chart. So we have a very clear map. We have had the direction towards this 20 area, but now the picture flipped a little bit because we have less resistance here and a little bit more as resistance here.
It's interesting on this. So where we went up to 3118, and the first place where you showed that the liquidity was pulled on the bids below, we went down to find support, and then as we went up to the top, you can see that the liquidity came in on the offers. We went sideways.
Yes.
Then liquidity was brought in and taken away. It was brought in a little bit on the bids and taken away on the offers. And then we found that support area at the VWAP, and then we reversed and went up.
Yeah. And the reason why we will talk about that was this move here, as well as this move. This was a sweep, and as I said, we will come to that. This is an capitulation. This is like a capitulation, but we will talk about that. So you see that how they wanted to they traded around this for about 2 hours in this area, and I have prepared an additional strategy chapter where I'm talking about the time. We will talk about this behavior Thursday or Friday latest, I think a Thursday, because now we should consider time as our indicator. They took here, let's say 1820, 2.5 hours or 2 hours at least, 2 hours at least, from this point to this point, and they didn't bring the price down. They capitulated with these moves, and why this is, we will see it later. So first of all, we have more resistance here, but on the other side, they didn't take the opportunity to bring the price below or bring the price further down. And on the other side, I'm calling this behavior business done. You see that? Business done. There's nothing there. Quit the job and close the office and enjoy the day, hopefully. That's one of really reliable trades you can use for yourself to see if the price is hovering around this area or around a certain price area for 2 hours, 1 hour, 2 hours, and it's not falling behind or dropping below. You can also draw here a rectangle around this area, so something like that, a marker, and then see that it's not dropping. We have a capitulation of the market here, and we have liquidity here, and liquidity acts like a magnet, as we said. So, but I don't want to jump further, because let me just see how this ended. I'm not sure. I haven't seen that how this ended. Whether they are going towards this 27 or not. Okay, they didn't touch the 27 area, doesn't matter. So our goal was to understand based on solely based on the pure on the liquidity, what the market is likely to do. Maybe if you got to fill here and to exit the market, it was excellent, because the next 2 hours, I guarantee you, were boring like hell. And then if you understand how to use time as an indicator, you could use a long position here for a few points and then cover at this sweep here. This and this areas here are the consequences of this move here. We will talk about later that. Okay, good, guys. Any questions to liquidity? Ideas, questions, suggestions?
So I know we have not talked about sweeps yet, Walter, but it's interesting to me, and I've never noticed this before. You notice on this one sweep, the liquidity dropped on the bids, and then when it went up to retest that sweep, even more liquidity came out of the bids and actually the offers.
Yeah. We will talk about that. I don't want to go through the sweeps now, but we will talk on tomorrow, on latest on Thursday, about the sweep, because they are so powerful if you know what you see, what you have to, what you trade, and because I know I don't want to go into depth here, because sweeps, when sweep happens, like here, let me show you that here. The market is not trading at those levels. There's no liquidity here. They're breaking, going through this liquidity here, absorbing everything, and it's dying at the top. We don't know where the top is. It doesn't matter, because we have another strategy to work with this kind of moves. But I would say, if you know what volume profile is, then we are talking about low volume nodes here. And if you look extremely sharply into the move, you will see that on some levels there's nothing traded. So the queue was not filled or was not depleted, because the move is so fast, is so brutal, that no one at these levels, 2150, 75, at these levels, were not traded. But let's postpone this a little bit, and we will talk about sweeps a little bit later, because it is really powerful when you know what to watch and what to happen. By the way, liquidity here on the way up. Here, look here. Energy is taken out of the market by absorption. You see that by this big dot, big dot here. And this happens all the way on the way up to the market, and when the market does not have enough energy to buy, then it stacks or it goes sideways. It takes time to find new buyers, for example. So it's a sign for us, for every one of us, that if we are lucky to understand that this is our target, and I tell you guys, there are not many people in the trading world who understand really what is going on and what is happening. So when you see that on that level, then you quit the game and let the market do what the market is doing. If you get here 7-8 points out, that's wonderful, absolutely wonderful. I would like to take the next hour to talk about the absorption, exhaustion, and I would like to talk about the sweeps. What we should know is the liquidity, absorption, exhaustion, and the sweeps. They are so important to understand also in the context we are using them, that we should take the time to go very intensively through these characteristics of the market. I see active and passive indicators which are on the chart, on the bookmap chart every day. So by active indicators, I don't mean indicators, classical indicators like technical indicators, moving averages, RSIs, CCIs, and so on and so on and so on. I mean trading indicators which are given actively, which are given or which were given by the market. So they are coming in time. They were plotted in time. We don't need to draw anything around. We don't need to draw rectangles, support lines or whatever. We got everything on this chart. Everything we need. In time, no lagging, nothing. The trading indicators or the active indicators are liquidity, absorption, exhaustion, sweeping and stop runs, which are kind of sweeps. And the confirmation indicators are order book imbalance. We talked intensively about the imbalance during the last yesterday and today. Pulling and stacking. We are again going to see what pulling and stacking is to make it a little bit more conscious. Spoofing, channeling, book flipping, quote stuffing, and iceberging or icebergs. These are confirmation indicators in my view, because they are supporting the moves. So when I'm in a trade like this one, I would like to see spoofing to the upside. I would like to see pulling and stacking in the order book. I would like to see that I'm not trading icebergs here because I don't like them. I would like to see book flipping as well. So when I'm long, I would like to see the support from this side, and so on and so on. So I have categorized the available market indicators in liquidity, absorption, exhaustion, sweeping and stop runs as trading indicators. That means active indicators. And passive indicators or confirmation indicators are order book imbalance, pulling and stacking, spoofing, channeling, book flipping, quote stuffing and iceberging or icebergs. Let's start with absorption. Absorption indicates the presence of one or more market makers who are sufficiently capitalized to consume all orders at a certain price. Absorption meets firm resistance when the limit page of the order book is recharged or stacked with new volume until the entire aggressor volume is consumed. Absorption always happens at price levels with equivalent liquidity. Volume absorbed is equal liquidity allocated. That means that what we have discussed and seen in the liquidity chapter, liquidity needs to be absorbed, or volume needs to be absorbed by liquidity, and that happens at certain levels where liquidity is there and enough volume to take everything out of the market. It happens, of course, with market makers or market participants who are sufficiently capitalized to consume all orders at a certain price. Absorption meets firm resistance when the limit page of the order book is recharged or stacked with new volume until the entire aggressor volume is consumed. Absorption is an absolutely important part of our strategies, of our understanding of markets. Because when volume and liquidity collide, then an absorption happens. Then energy is taken out of the market. It's unfortunately, it's not so easy because it's easy to classify absorption what it is. But absorption, as you will see, can happen on several levels. So also in this case, unfortunately, this is not an holy grail. That means we can use liquidity in absorption and we are done. We need experience, we need an understanding, and on some days it is so obvious, it is so clear. On other days it's absolutely not clear what is happening here. The market fool us around, and in this case, my best advice is, if we don't know what is happening here, stay away from the market. Wait until you get a clear picture. In our case today, let's go back here. No, what gave me a, it was here. In our case today, in our case yesterday, it was absolutely clear what is going to happen. It was visible from the beginning on. The question was, yes, how should we trade it? What can we do? Where should we go long? But it was obvious that this is the target, or this is the area of the target, of our first target. It was clear, at least for me, and it will become very clear for you too, when you have enough screening time and experience to see, okay, we are starting in the middle of nowhere here in 15, but this is the target. The question is now when to enter and where to enter. This is the question. In this case, we have the target here in front of us. Reasons for absorption is market is changing his mind. Traders has reached their target, business done. Distribution or accumulation takes place. Covering or flatten open positions. Adding on or opening new positions. And this covering or flatten open positions can happen over more than one price level, and adding or opening new positions can also happen over more than one price level. So we will see how this works, but first let's come first to the theory. We will see in some cases that absorption happens over several levels until the move exhausted or is exhausting, and that means in some cases we will see that absorption takes place and the price is going further down or further up because the participants or the market makers or the market participants covered their positions before the low. The low happens not because of the covering, but because uninformed traders are still trading. They are hoping that other trader will support their move. When do I know when others follow me? When do I know when others follow me? That's the point. And when you miss something like that here, absorption at that level, for example, when you miss that, you are trying to sell again, but you are selling in nothing, so no one wants to support you here. That's the absolutely fascinating question. When do I know when others follow me? And I need other traders to support my trading idea. Let's go to the theory. I've taken this files from Bruce, my friend Bruce from Bookmap, just to illustrate what is happening here. But I think it's very clear to you. So we have here, this is the offer side. There's a little bit another presentation. There's a little bit another presentation than this one. A different presentation here. It's the time. We have the time axis here and the price axis here. So we have 12 contracts here, 16 contracts there, 24 and 32. Let's translate it to this one. We have 32 contracts here, 24 contracts here, 16 contracts here, and 12 contracts here already. That's always okay, everything okay. And we have 15 contracts here sitting, 18, 22, and the long-term liquidity. Long-term liquidity here. That's the same picture as our limit order book. This is the long-term high liquidity here. Long-term high liquidity. Okay, good. So we have one at market and the long-term liquidity is sitting here. Take the next one. So we are trading 15, 18, 17. That means we are trading through these contracts here, 15, 18, 22. When you are trading that, we have left 5 contracts on the before the long-term liquidity. 15 plus 18 plus 17 is 33, 40, 50. That means 50 contracts. So we have 18, 22, 40, 55 contracts here on the way down, sitting on the bids, and they are trading 15, 18, and 70 into the bids. So we have 5 contracts left. We are now 1 tick away from the best bid, from the long-term liquidity here. And what happens? A new sell comes in. New sell comes in, and at 5 bids, and we have 45 also on the bid here. That means 80 contracts are left here, still remain at the best bid. 80 contracts still remain on the best bid. Another 50 hits the 80 contracts. We have 30 contracts on the best bid. And now the book is flipping. Someone is trading at 12 contracts at this price above. And that means if there are no interest in trading further down, in trading in hitting the bids, that means that all this volume is absorbed at one level. So limit buy orders and bid stops the sell momentum to downside. Price shifts to best offer and moves 3 tick higher. In case there's no one is interested to trade this price level and take these 30 contracts out because everything was sold into it and there are no further sellers. Okay, I think it's very clear what is happening here, isn't it? You see this phenomenon of absorption in every market. There's no exception. There's no exception. So if you are looking at oil, if you are looking at treasuries, if you are looking at whatever market you want, you will find that the absorption of volume in a market happens in every single market. In stock market, of course, you see here, this is Apple. You look, they had 227,000 shares traded on this level, 190. And you see how they resisted with the liquidity. They traded, but they couldn't break this level here. They couldn't break. They resisted. This is a firm liquidity. And if you are trading shares or you want to trade shares, it is absolutely important for you to have the same knowledge about the future market as well as the stock market, because this technique, this mechanics is valid for every market. Now you see that on this picture too, absorption took place at 36 here. Absorption. This is a little bit an older picture, but it shows extremely well what is happening. This is volume area here. We have a low volume area here. Everything at these levels was absorbed, and then they are pulling their liquidity at this level, and that means business is done. Now we have different kinds of absorption. It would be extremely easy and good to know that we have liquidity, absorption takes place. In most cases, the price will go a little bit further down, or depends on further up, and then the market will dry out, and possibly the market comes to a stop here, and then it goes further up. But when the market is trending, you will see that some of the market participants will place, this is Microsoft here as stock, will place their liquidity on the way down. So maybe a lot of people are covering here, and they got to fill because the market is in a sell mood. That means they are selling everything, absorption. It's not said that the market is holding here. We will see some other examples shortly. One of absolutely exciting indications is when it works in this case, because we have, you see, long-term liquidity sitting on oil. This is light sweet crude oil, yes. We have long-term liquidity sitting there, and we have above this liquidity now absorption takes place here. And what is this? That's what I said, absorption takes place at this level, and then the market is probably to go up. Traded volume is, you see that. Therefore I'm try to motivate you to use the limit order book to see this behavior here very clearly. They are trading 1,143 contracts into the 2808 and then absorbed everything on the market, everything. Now, it's very clear, I think, what absorption is. We will see a lot of examples. It is important to distinguish a little bit, because absorption is not, it happens, but we can't use absorption as an absolutely reliable indication or indicator. My experience is when absorption happens, wait until you get a confirmation. The practical point of absorption is to notice it, to recognize it as absorption, and to see what is happening next to absorption. I put 2 pages or 3 pages together to show you my view on absorption. That means absorption is not always a reversal or trading signal. It is not like liquidity, it's not. Absorption is not always a reversal or trading signal. Therefore, I said when we started today that only looking at liquidity, it's interesting. It's absolutely a must to know what is happening with liquidity and how liquidity acts. But absorption is not always a reversal or trading signal. And I will show you a lot of examples where I would like to take you on an easier way for your trades. It is important what happens next. Do we have a short retracement? What kind of retracement up to the next liquidity level? We will talk about the pullbacks. It is a breakthrough. Liquidity as a support, resistance, question mark, absorption, reversals, and continuation. There are a lot of, not a lot, but some things we have to keep in mind. What is happening around absorption? That's the main question. What is happening around absorption? To illustrate that, I have put 3 examples, most common examples you will see and spot every day. Now, this is the liquidity level. Now the price is trading, the market is trading down towards this liquidity level. We have absorbed, the absorption takes place here at the liquidity level. Everything is absorbed, that means energy is taken out. The market trades a little bit lower, makes an attempt for a reversal, and new sellers are coming in, because once this energy is absorbed and a new sellers are coming in, it's easy to go through this level here. It's absolutely easy to go through this level here. This is very short retracement, indicates strength in the price movement. Small, it's indicated by a small short covering. No liquidity above or below, absolutely important, and price drops further. The second pattern we have to keep in mind: market is strong down. It meets liquidity. You know what is happening. Absorption is happening. A part of the energy is taken out of the market. And now what happens? Short covering starts here. Short covering starts here. A lot of people think, okay, that was it. And when you look at a candle chart or similar charts, you might have, yes, that there might be a Fibonacci line or indicator line, whatever. Then the market starts to, or the market participants starts to cover their shorts. If they cover the shorts, the market price is going up, and suddenly you will recognize that liquidity is forming above. Either liquidity was there, or when the market starts to cover their shorts here, then liquidity comes up. And that's a wonderful pullback area and good opportunity to reshort the position. If you miss that one, if you miss the move down, if you don't re-offer, in this case, the move down from the beginning on, then it's the best strategy instead to jump on the move, to wait until you get a pullback pattern. This is a retracement. Short covering takes place. It's a little bit higher than this very, very short covering here. Liquidity above or below. It's the same for bullish markets, for uptrend markets. And the price seeks liquidity as always. And liquidity acts as resistance or support in this case. It's clearly resistance here. That means price goes up against this level as a resistance and then needs a little bit time and then drops back through the level. The reason is we don't have a support here. The support was taken out here, and if the market is extremely in a negative mood, then they will surely go through this level to the next level. And I think it's an interesting day today. We had this pattern too. It was extremely in a sell-off mode. Nothing helped. So we had absorption there. We have on this level, maybe on a third level. On the way down, the energy is taken out, but we can't predict. Friends, we can't predict where the price comes to a stop. If we are in this condition, or if we are in this situation, the price is coming down, it breaks one level, absorption. It takes a little bit of time, and the market is strong bearish. That means they are selling everything into the bids, and there's no one who wants to stay in front of this move. Then we don't know whether this is the first absorption, the second, or maybe a third absorption before the market stops and reverses. It's a massive sell-off. Liquidity is liquidity equal covering. Price seeks final support or resistance. So it takes time. We don't know in this move, in this very brutal down move, all laws about the liquidity and absorption we have talked about, and the prioritization we talked about. It's not valid in this case here. When we come to the strategies, then you will remember all these pieces. All these pieces fits together like a puzzle pieces or parts. They fit together to a complete picture. It is not possible to say when we see liquidity we have to sell or to buy. It's not possible. It works, yes, but it's not 100% reliable. And it's not possible to say when we have an absorption, it's a buy or it's a sell. It works from now and then, but it's not reliable. We have to find a workaround this market behavior, that I'm saying I would like to have a probability which is higher 70%, which puts me in the position that I first can control my stop. I know what I'm doing here. I know where to enter and when to enter. That's my personal goal and that's my personal pretension. That's my personal pretension to me on my trading, to say I want to know this. So pattern as well. We have good reversal potential when the liquidity is firm. You see how the liquidity chapter, the liquidity topic and the absorption topic goes hand in hand. So we have firm liquidity, it closes, it is absorbed of course, but you will mention, or you will see sometimes that liquidity closes again. They stack to the liquidity on the offer or bid side, it doesn't matter. It's valid for both sides. Once this is the reversal situation and we have an absorption continuation, that means we have the prices hitting the liquidity here, the volume is absorbed, it needs time, that means it makes a retracement, and that's nearly always the time. Depends on, is this retracement only a few ticks or few points? That's the question. And then it continues up, and then what happens then? Book is flipping. That means they are supporting the move up into the next level, to the next liquidity level, which is probably sitting here around. And the same is also valid for the downside. So this is where we should have to work around. Please keep this in mind. It's very easy. So if you hear or see that the first time, I know it's a little bit, it's not a little bit, but it's overwhelming. So you have to fit this knowledge into your trading. When you often see this one, absorption, this was a short retracement here. Absorption at this level here. Then it retraces a little bit further up and then goes further down to the next liquidity level. You see, please mind that there are no liquidity above. There's no one who wants to attract the price at these levels. Liquidity is below. Liquidity acts a magnet as always. So this is absorption with retracement. That means the price is coming down. We will see that tomorrow is hitting the liquidity level and then retracing back to the next liquidity level and then coming back down. And this is the total sell-off. Interestingly, we had it today. Either you are in, you are short, or you are not short, but when you are not short, then wait for a retracement, but there is nothing. You see that very clearly, there is nothing to trade here. What is this? Yes, this should be a demonstration about several techniques, but it's not so crisp, I would like to say. It's not crisp enough to explain. The move is down, so you wait for the retracements, for the pullbacks until the next liquidity level, and then you reshort this market. The MAE, that means the risk is very low. Once you know that the market is going back, retracing here, risk is very, very low. The stop is above 73 here in this case. So you don't need to have stops greater than maybe 1 or 2 points. Finally, I would like to talk about exhaustion.
Walter, with the absorption patterns, would it be would the probabilities be higher with the absorption pattern of the short retracement, that if there's no liquidity around there, that the chances are that it will probably continue.
You mean the probability with this retracement, is it higher than
Yes.
with this one?
Yes.
Hard to say. What I have learned in my trading career is you can't play a breakout here, but from my point of view, I have burned my hands more than with breakouts than without breakouts, because sometimes they work, but more often they don't work. So if you want to be secure and to enhance your probability in trading, then I would like to trade this one here.
Okay.
But if you ask, I would recommend wait until you get this or a similar pattern, because you know then that the market took out this liquidity, is short covering, the liquidity came up, your entry or your stop should be above this liquidity. That means if you have the chance to get a fill here around, maybe your stop is not more than 2 points, even sometimes 1.5 point in terms of ES mini. So the risk is clear and the opportunity is there, so the probability for this trade is higher than 60%, and therefore I would like to use this one. But also, if you see that they are closing liquidity again, they are trying to get everything on this level, this is also a very good opportunity. That's
You make a very good point with the risk, where that first one you don't know where your risk is.
Yeah,
the second one you do.
Yeah, you can. Yeah, as I said, you can do following. You can draw a line here, and that's a classical breakout trade. And your stop must be at the top of the last swing here. So yes, that's the one. But as said, I need a little bit more security in my trading, and that would be my favorite here. Or that is my favorite. This is this one here. So if you want to sell this, a similar pattern, draw a line here and then go short around 21 here. And the stop should be around 29.30 here in this case. That's the more secure. You will see that when we talk about today's trading, there are several good opportunities where the absorption takes place. So it takes time, but because a lot of traders are covering their shorts because they are thinking this is the end of the move, or maybe the bottom, not the end, but the bottom of the move. Then they are trying to cover. Then the market is not done, and the well-informed traders are forming liquidity somewhere here, and maybe they are touching the liquidity 2 or 3 times, and then break down or sell off.
Yeah, I'm okay. I actually wanted to ask the same question as George did.
Okay, great. Yeah, fine.
Difference between them, especially the first and the second, because they're very similar. But like you said, it's better to wait for the confirmation. For the
Yes, that's the point of this education part of this seminar. Is I will show you that liquidity is important and that absorption is important, but it is not reliable to think like a lot of people are thinking outside. So maybe they are using Bookmap, and today we have more fashioned platforms, software platforms, which are also using liquidity or placing on displaying liquidity on the candle charts. You can do that on Sierra charts, and I saw there are other companies who are more, not concentrating on footprint, but also displaying liquidity. That means nothing if you see liquidity in front or on your chart. You have to understand the context. And if you are not sure what to do, in most cases you will get a confirmation for your trade. We will see that in what I mean with that. So there's no need to trade everything on the way down. Or simply wait until you get your chance. It's annoying, I know. Colleagues, it's annoying when you miss the trade. When you miss the trade, you know it's going down. We will see that's in preparation. We can predict a move to a certain extent, and the move goes our way. We are not on the move. It's extremely annoying. You curse everything. Oh, at least me. So excuse me. At least me. I curse everything, and I'm starting to become impatient. But that's the wrong strategy. So discipline is needed. Then, because this market meets liquidity, hits liquidity, it comes to an absorption. That means it takes time to find another buyer or another seller, and during this time you have enough time to reconsider your position and say, okay, that's the scenario I would like to do, because I have a reason 1, liquidity, I have a reason 2, I have an absorption here, and I'm entering at the lowest possible risk. Maybe the auction is not going further down, but you won't lose anything. That's the point. If you are in this position, maybe the move is only going for 4 points, for example, 3-4 points. But anyway, you did it right. You followed your plan, and in best case, you get 2 or 3 points out of it. That's okay. That's the luck we need in trading. You know, tomorrow you are entering the same entry here, and the price moves down in 5 minutes for 10 points. On the next day you are entering the same, you have the same situation, and then the price moves only 1-2 points in half an hour. But anyway, if you are in green, if you are in positive, if you are in profit, then you're on the safe side. Exhaustion. I would like to discuss exhaustion before we are continuing with the sweep tomorrow, because it is one of the remarkable moves in the market. Exhaustion is also absolutely interesting. Exhaustion is a depletion of market orders on the last ticks or price. We observe decreasing volumes. Exhaustion is a price level of last seller in a downtrend and a price of last buyer in case of an uptrend. Let me explain you that. It's the same situation like this one. So we are trading 12 contracts here. Market is buying 50 at this price. Now the market is trading lower, 15, 13 on the best bid. Let me see, what was this? 15, 13, 10 and 8 contracts. So they're trading and hitting the bid here. 10 contracts remain before the best bid. They are selling 5 contracts. That means we have still 5 contracts on the current price on the best bid. So sell again 5 contracts and nothing happens. And then suddenly one comes back and trading on the offer and lift the price. Exhaustion is extremely important. It's the counterpart of absorption. Let me show you what exhaustion is. You will see very low volume trading at one price. We also see divergences here. You see that? These peaks, you see these peaks here? You will see that every day. See these peaks here? No one wants to trade at 92. It is the same behavior. It is absolutely the same one. I will show you another picture. The matching engine, the CME matching engine. Please go back to CME. I will collect the web links of CME if you are interested to understand what a CME matching engine is. They are trying to find out if someone is willing to trade at 110. Is there one who wants to trade with me at 110? It's one who is willing to trade at 110. It's kind of polling. The matching engine is listening, is there someone who wants to trade with me? And here it's the same. Is there someone who is willing to trade with me? Is there someone who is willing to trade with me? Is there someone who is willing to trade with me? No? Then I'm going back. I'm reversing. So that's the logic. So if there's no one who wants to trade, the matching engine is going back. We did it on Monday. I was the one main show here. I was the market maker, the matching engine, the auctioneer, and then I traded back. I traded back until I found buyer at a certain level. Then the order were filled and I traded back up. It's not perfect. It's far to be perfect, but it's the scheme of how the matching engine is working. And you see the behavior of the matching engine here as well here. Consider the time factor here. This is the euro US dollar here. No one wants 2 times, 3 times, 4 times, 5 times, 6 times for 1.5 minutes here. This was absorption on this level, and then the market is going down and trying to trade, and somewhere in this market there is no interest. There is no further interest in trading the 20 level, for example. I'm just looking. Let me see where I'm looking for a chart. 127. This is the DX viewer from the X view, and the beauty of this viewer is that it shows the mechanism of the matching engine. I want to show only one point, just to make you curious. This is the price 37.50, and this line is 37.25. So we are trading 37.5 and 37.25 here. That's the price. Yes, you see that? This peaks here. This is the matching engine. The pulse is one ready to trade at 25 and a quarter. Is someone ready to trade at a half, and so on, and so on. This is extremely short time, so it's not necessary even to know that. I think it's not necessary even to know that. But when we translate the polling of the matching engine to our charts here, then we understand better what is going on here, what is happening here. We can explain it. We know simply. It's a good knowledge. Okay, guys, it's a good knowledge. It's important to know, and you will see that in some exhausted areas how impressive it is to know when exhaustion takes place. But it's already good to know that we have a matching engine who is polling, who is trying to see if there's one party interested in trading. If there is no party interested in trading, the matching engine must go back, and find buyers who are willing to buy again and to drive the price up. That's absolutely important to know. We will see a lot of examples on the way when we are going through different strategies and so on, that exhaustion is an extremely important part of our trading. Do you have some questions to exhaustion?
Walter, would it be fair to say when you see, say for instance, you had selling exhaustion towards the end of that current chart, and then you see business done up there, would that be a confirmation that price is the pressure to go down is
Yes,
down?
yes, absolutely. The disadvantage, yes, absolutely. But the disadvantage of business done is that it happens, I will not say long, but it happens time after the absorption and after the exhaustion here. So business done is an extremely helpful indicator. Absolutely. No doubt about that. But it happens few minutes after this business was really done here. So because they reached what they wanted, they canceled everything here. It's let me say that, what is 10 and 16? That means 6 minutes. So after this liquidation, after this absorption, they took it took 6 minutes before they canceled everything. Now you are safe. You are sure that this was a sell here. So
as you see in that second level down where you have the second circle,
yeah,
from the left, at that 2720 area, 21 or 2075, you had some buy exhaustion there. And then
you have, absolutely, yeah. The point, the engine, as you said, pulls this one, asks for, what is this, 21? To trade at 21, or is he willing to trade at 21 with me? No, George is not ready. Is he willing here? No, he's not ready. No, he's not. Okay, when George is not ready to trade with me at 21, then I'm asking the next one, who is ready to trade at 2075 with me? And so on and so on. And if this happens, you will get additional information that there's no intention to buy the market in this case. And so the consequences are, if there's no one ready to buy the market at this point here, then the market is going down. But we know liquidity is a magnet, and so we are trading. This was absorption. When we are entering, then that's our target here at what is this, 18 area here, 2018 area here. We can take this as an exhausted area and trade and sell the contracts until the market reaches this 18 area here.
Yeah, it's really fascinating to me as we get more knowledge from you, Walter, that for instance in that area they were bracketing, so at 23, the liquidity was probably 1A and maybe 1B down at 18 or vice versa, and then you see the exhaustion here, and then as you move you can see how hierarchy maybe 2 is the offers coming down with price, and then you see the absorption at 18. However, you see the now hierarchy 1 is now down at 16, and then you see exhaustion, and you see the short-term high liquidity come in at 1975.
Yeah,
it's really fascinating to me to break this down now.
Yeah, absolutely. This is theoretical knowledge, absolutely theoretical knowledge, because we have to know that. When it comes to trading, I will show you some entry and some suggestions about strategies. You can make your own variations around that, but from my point of view, it is absolutely important. It is absolutely important to have the knowledge what the market is doing. We'll see in the upcoming topics how to use this knowledge for our trading. Sometimes it's so obvious. I say it again. Sometimes it's absolutely disclosed. Sometimes it's absolutely obscure. Sometimes we don't know what is happening. And in this case, stay out of the market. But sometimes, like this one here, let me see that, where we can see exhaustion here. We had absorption at this level. And you see what is happening here. We had absorbed, I think this was the level with 1000 on it. And then the market is trading. But you can also see trading here. You can also see that the volume is depleting, is lower and lower. You see the matching engine is the one who wants to trade at 1250 with me and so on. Let me see whether I can find. So this is really exhaustion because there is no good volume to trade further than this 12 level here. Also here, look here. The matching engine asked 4 times. No one wants to trade this 1475 level. Then we had good volume here. Okay, it's in a way it's clear. We have had good volume here. We will see that, and that's the confirmation. We had good volume here, and then you see less volume here. This peaks. Let me see the exhaustion at the liquidity level. Whether we can see here. Yes, that's really a nice one here. You see that? We have huge volume or good volume, which is going up into the liquidity level. It was absorption here. And then watch what is happening here. Get a little bit. You see that? Let me see, what is this? This is 15 traded at 2075, 21 traded at 2075, and 12 traded and at 23 quarters here. No, nothing. These are guys or traders who really don't know what is happening here or what happened here. They are traded into this strong liquidity. It was, I think, 1400 or something like that, 1400. And then market dries out because the energy is out of the market. The energy was taken out of the market here, and the last one was taken out of the market here. And then the market is trading up, down, and you can see literally what is happening here. Nothing. You see these small, tiny micro dots here. So you have the opportunity either to sell this one for a few points, but it's really demanding, or you will take the opportunity to buy this one maybe at some levels here, because we said that price is seeking liquidity here. And let's see this one. This is a classical we should take for tomorrow. This is the sweep, and you see exhaustion here. Let me show you that one. Massive divergence. This is a massive divergence. You see that? And you see exhaustion here. You can measure exhaustion by the volume bars, And also you can measure exhaustion with your eyes, seeing that there is nothing around here. And you will be awarded with 2 points, at least 2 points here.
Look at the liquidity drop there,
Yeah,
just
Two.
before, at the end of the exhaustion.
yes. Okay, we will have enough examples here to discuss, but what is important to go through this theoretical discussion, because you should be aware and you should sharpen your conscience, because this all gives you an absolutely clear picture what is going on. Maybe not on Monday, not on Tuesday next week, but if you keep this in mind and watch it every day in your traded instrument, you will see that also on ZB. You see that in ZB here, for example. That's a nice one. We have absorption here. We have absorption here at this level. So again, liquidity acts like a magnet. The price is heading up, heading up, heading up, heading up, because this was our target, absorption. And I'm sure this is exhaustion here. Look here.